This video is going to take a look at using Excel to create a Monte Carlo simulation of wealth accumulation. Essentially what this is just looking at a bunch of random scenarios instead of using one constant rate of return, allowing random returns, and instead of just one, how much will I have at retirement, we can look at 100, 200, or 300 different possible outcomes at retirement. That'll give us a richer outlook or more depth on what's going on. Couple of objectives we're going to try to accomplish with this video, and just real quick, we're not going to get all of these objectives into the first video. It's going to be a multi-part video. My video capture software doesn't seem to like big files, so I'm going to have to break it into a couple minute parts on this. But first thing we're going to do is introduce the idea of log normal random returns. Random returns are more realistic in an investment scenario than a fixed or constant rate of return that's often used in time value of money analysis. And log normal returns are better than normally distributed returns because normal distribution is symmetrical, but most investment returns are skewed. What we mean by skewed is that the worst case scenario for investing in a stock is you can lose your entire initial investment, a negative 100% return, but you can more than double your money in the best case scenario. So you can earn a 200, 300%, or theoretically unlimited. Because of that skewed distribution, the normal distribution is probably less appropriate and a log normal distribution is more appropriate. We're also going to look at absolute versus relative cell references and how to use those in formulas. A relative cell reference is what most people are familiar with within Excel. For instance, if I'm referring to columns or to cell C3 in a formula, Excel might not read that as C3. For instance, right now if I'm in cell B2 and it sees equals C3, what it really is seeing is over one column, down one row. If I move my formula to B4, it will go over one column, down one row, and plug in C5. So that relative cell reference is often used when you want to copy formulas and move them around in the spreadsheet. However, sometimes when I say cell C3, I want C3 and I want it to be locked into that. So I need to use an absolute cell reference. We'll use both in this spreadsheet and talk about why they're important and how to know when to use which. For larger spreadsheets, sometimes you'll want to be able to freeze panes, which means lock the column headings and row headings so that they're visible on screen at all times. Now when you freeze panes, you can still edit them, but they'll always be visible for you. And as I mentioned, since this is a Monte Carlo simulation, we're going to be looking at the role of randomness on wealth accumulation. Instead of saying I'm going to earn a 9% rate of return for 30 years, what we're going to do is say I've got an expected return of 9%. How much wealth will I accumulate after 30 years in 100 different scenarios? What's my best case outcome? What's my worst case outcome? What's my average? So this is more realistic because a 9% rate of return in a real investment scenario sometimes means over the next 30 years I get lucky and average 11 or 12%, or maybe I get unlucky and average 4 or 5%. It's going to have a pretty big impact on my wealth accumulation. Even if I average 9%, the timing of those returns can have a big impact. If I'm adding money on a regular basis, it's more important for me to have big returns near the tail end of my period than at the beginning. At the beginning, I don't have much wealth accumulated, so doubling that wealth is not going to have a big impact. If I've got a retirement plan and a 401k plan, and I'm 2 years out from retirement and I've already accumulated let's say $800,000 and I get a 50% return, that's $400,000 extra added on. On the other hand, if I get a negative 50% return, wow, I've just been cut back to $400,000. If that same return had happened in year one of my saving, it wouldn't have been that big of a deal. So we're going to look at all these objectives in this series of spreadsheets. Real quick, let's pop open the spreadsheet. Got a few basic things already set up. My input data. Remember, we want to keep formulas to not have many numbers in them but more cell references. In my scenario, I'm going to start with a $5,000 initial investment. You can do whatever you want as far as an initial investment. My monthly contribution is going to be $600 per month. I'm going to assume that's going to come at the end of each month, and I've got a 30-year outlook. My average return is going to be 9%, and my anticipated standard deviation is 16%. What I did is I assumed a relatively aggressive stock-based investment strategy. 9% is a reasonable historical average return, so I'm going to assume that's going to progress going forward. And I looked at the standard deviation of the S&P 500 over the last about 20 years and found that that averaged about 16%. So that's what I decided to plug into my scenario. If you're more conservative, you might say, well, let me put a mix more weighted towards bonds in my portfolio. Maybe your average return is going to be 6%, but your standard deviation will be lower. So whatever you feel is appropriate in your kind of outlook, higher the return, the higher the standard deviation you're going to have. We go ahead and stop here, close up this video, and we'll keep going in part 2.